Welcome to another episode of Money Matters. In this episode, I'm going to be talking about the coronavirus or COVID-19 and the effects on the markets. So, it's the second week of March and markets have taken a hit everywhere. Double-digit figures. It's the second Monday where it's taken a massive hit, from the Hang Seng Index to the S&P 500, Dow Jones, Nasdaq, so on and so forth. At first, it was perceived to be local to China and somewhat Asia, but now it's just exploded globally. Markets receive feedback from various industries on a slightly delayed basis. We start to get the economic slowdown effects in various industries such as F&B, tourism, hospitality, and even the Chinese factories' outputs have slowed somewhat. There's a natural delay to when we receive the data about the economic slowdown effects of the virus. This could just be the beginning. We will have more bad data for months to come. Locally here in Hong Kong, people are working from home. They're eating in. They're simply not going out. Large events have been cancelled all across Hong Kong. People are just not spending money and they're not going out. The usual busy streets of Hong Kong are serenely quiet. Across the globe, international major events have been cancelled as well. Events such as the Geneva Motor Show, Basel World, and including the Mobile World Congress. This leaves many wondering the fate of the Olympics this summer in Tokyo. China accounts for 3/4 of worldwide cases. And however, it seems to be that China might just be getting control over the spread of the virus. Overseas, however, this could just be the beginning. There may be an uncontrollable spread across other parts of the world. Nations such as Italy, Iran, and South Korea. There are even signs that the spread is going to other parts of Europe and including the US. This almost seems like a scary movie remake of the 2011 medical action thriller, Contagion. If you don't mind a scare, go check out that movie. Some will compare this COVID-19 event to that of SARS in 2002, but you simply can't draw direct comparisons. For one, we're in a different set of circumstances. A few years prior to SARS, in 2000, we had just suffered the effects of the dot-com bubble bursting. This time around, apart from a slight correction in 2018, we suffered a number of years of low volatility and steady returns. So they are very different circumstances. However, if we can make the assumption that we will defeat COVID-19 at some point, and markets find some sort of return to form, economies return to form, and we find some sort of equilibrium, I think there's some great returns to be had. Where others see disaster, I think actually is a real good time to buy in right now. So SARS hit Hong Kong particularly hard, second after China, where the origin of SARS came from, with 1,755 cases and 299 deaths. That's a 17% fatality rate, and far worse than COVID-19. After 8 months of SARS taking effect, Hong Kong started to find some return to form. Businesses returned to normal, people's lives returned to normal, and property prices shot up, stock prices shot up. We saw a massive return to form. How many Hong Kong people said that if there was another SARS event again here in Hong Kong, that people would take advantage of the opportunity? Well, I think it's happening again. So whilst COVID-19 is not SARS, I think we will find a resolution to COVID-19 and that we have an extraordinary opportunity to make some great returns in the markets without really trying that hard. Even if you took a broad position in the markets, you'll do pretty well. But if you prefer a more sniper approach and you wanted to pick very specific positions, then you stand to make even greater returns. I'll share my personal portfolio, personal stock picks that are relevant to my personal objectives. Bear in mind that these may be quite time sensitive, so by the time you watch this video, the prices may have changed quite a lot already. So I'll only pick 3 and I'll read off this list if you don't mind. My first one is MTR, Hong Kong's subway operator and landlord to many shopping malls and properties. Harder hit by protests before the virus and now taking a double whammy. I say buy and hold for 2 years. HSBC, a recent announcement that they'll be cutting 35,000 jobs worldwide, mostly from the US and Europe. If you read the headline only, and it's dire, however, a behemoth of a bank like HSBC, I see HSBC doing a bit of spring cleaning. It's getting rid of its inefficient operations and reallocating resources to Asia and its investment banking operations where it's far more profitable. That's only a good thing. It may take a bit of time for them to restructure, but I say buy and hold for 5 years. It's extraordinary right now and it's definitely a buy. Final one is AMD. Specific to the effect of COVID-19 in particular, we see that recently anyway, AMD is having a bit of a surge and threatening Intel on many fronts. The price is now attractive again, so buy and hold for 3 years or longer. So there are plenty more, but I'll just share these with you today. But in these extraordinary times, you have to listen to your head. If you just read the headlines, it's certainly very scary times to invest right now. But listen to your head. Many stocks, certain stocks, many assets are very, very cheap right now, and they are absolute bargains. So do what you can, get involved, but only buy what you understand. And if you don't, hire a trusted professional. Whatever you do it quick, because like many of these types of opportunities, they simply won't last. Thank you for joining me on this episode of Money Matters and the coronavirus and the markets. Leave your comments below and let me know your thoughts on what other videos you would like to see. As usual, please subscribe and see you next time on the next episode of Money Matters.